In this session, we will talk about the commercial banks, or we may say the banks which are dealing with general public, and how many types of banks are existing in Indian banking structure. So we will be talking about commercial banks, those which are accepting deposits from the public for the purpose of lending, and these commercial banks are further divided into several categories. So the first category for the first division of the commercial bank is scheduled bank and a non-scheduled bank. A scheduled bank is the one which is included in the second schedule of Reserve Bank of India Act, in which they must fulfill three conditions, and failure to meet any one of these three conditions would make them non-scheduled bank. What are these conditions? The first one is it must have paid up capital and reserves of an aggregate value of at least rupees 5 lakh. It must be carrying on its banking business in India, and it must be a corporation or a cooperative society, but not a partnership or sole proprietorship firm. That means if a bank has to be a scheduled bank, it must have its capital, paid up capital, more than 5 lakh rupees. It must be having its business in India, and it should be a cooperative society or a company under the Indian Companies Act or Cooperative Societies Act. Then it would be called a scheduled commercial banks. Why it is important to be a scheduled commercial banks? Because they get certain privileges from Reserve Bank of India in the time of difficulty. These privileges are not available to non-scheduled banks. So let us come to what is a non-scheduled bank. A non-scheduled commercial bank is the one which is not included in the second schedule of RBI Act 1934. That means the bank which does not fulfill any one of the three conditions which were laid down for scheduled bank, that bank becomes the non-scheduled bank. And these banks, the non-scheduled banks, why they are allowed to operate when they are not fulfilling the condition? They also maintain the reserve requirement and liquidity ratio, the one which are specified by Reserve Bank of India, but they do not keep those reserves with RBI. Now in that case, they are supported by Reserve Bank of India only in abnormal circumstances. Normally, they have to protect their own interest with their own reserves only. The benefit of support from the government and RBI is not available to them in normal circumstances. Jammu and Kashmir Bank is one such exception, which is a non-scheduled bank and which is operating as non-scheduled bank but getting all the privileges from RBI like a scheduled bank is getting. The second category, and here I would like to add that regional rural banks, which are also part of commercial banks, which are also recognized as scheduled bank, but they are a separate category. How? These regional rural banks were set up on the recommendations of Narasimham Committee in 1975. These banks were set up actually to support the functions of commercial banks. The places where commercial banks are not able to operate due to some financial and technical difficulties, but the bank financial inclusion is required in those places, and cooperative banks are having insufficient funds to support that economy, there regional rural banks come into the picture. Now, how come they are the part of commercial bank? The capital structure of a regional rural bank is in the form of 50% of the capital is provided by central government, 35% of the capital is supported by sponsoring public sector bank, and remaining 15% of the capital is provided by state government. That means we can very well see that after the central government, the maximum contribution is being made by the sponsoring bank. The first regional rural bank was Prathama Bank, sponsored by Syndicate Bank in 1976. So at present, the requirement of regional rural banks are decreasing because of the unprecedented branch expansion and branchless banking by the commercial bank, and consolidation of weak banks is taking place. Therefore, we have now 56 regional rural banks. The idea behind that regional rural bank is the interest rate is comparatively low and they work for supporting the regional rural economy of a particular area. Now, coming back to the scheduled banks are further categorized as Indian banks and foreign banks. Now, any particular scheduled bank, that means the bank which is included in the second schedule, may be an Indian bank, may be a foreign bank. Now, when it is called an Indian bank, when it is registered under the Companies Act of India, and they are having their branches in India, they may have their branches abroad. Now, these banks which are having their branches in outside countries, they are supporting the operations of Indian economy away from our country. Now, a foreign bank is a bank which is not registered under the Indian Companies Act but registered under the Companies Act of that country from which it belongs, and it might be operating as a branch in India or as a subsidiary of that particular bank from that origin country. These type of banks play an important role in shaping the attitude and policies of foreign government, companies and their clients towards India. At present in India, there are 46 foreign banks. Now, the Indian banks are further divided into public sector banks and private sector bank. Now, when I talk about a public sector bank, the public sector banks are the banks in which the government has a major shareholding. To be precise, it generally goes to 51% ownership with the government. The shares of these banks are listed on stock exchanges and they are 27 in numbers at present. So, if I talk about a public sector bank, if I give you the example of that, it is Punjab National Bank, even the State Bank of India or Indian Bank, Vijaya Bank, Canara Bank. All these banks are public sector banks. When I come to private sector banks, these are the banks in which majority of stakes are held by private individuals. These kind of banks came into existence after 1991 economic reforms. That is why once they were referred as new economy banks, and they are very strategic in their thinking and operations, and of course they have accelerated the pace of development of our economy. At present, we have 26 private banks in India. To name a few, ICICI Bank, HDFC Bank are the examples of the leading private sector banks in India. Now, when I come to public sector banks, though the classification will not matter that much, but public sector banks are further used to be divided in two parts. One, State Bank of India Group, another, other nationalized banks. When I come to State Bank of India, it was one of the oldest bank because it was known as Imperial Bank of India, which was converted into a State Bank of India on 1st July 1955. 1995. It was the first one to make a public issue in 1993-94, after which the shareholding of RBI has come down to 68.93%. Though State Bank of India is also a public sector bank, but because of its large major market holding, it was working before 2017 as a State Bank of India group. Why it was called SBI Group? Because State Bank of India had 7 subsidiaries at the time of independence. Those 7 subsidiaries were the princely states in which State Bank of India was operating. But in April 2017, we have observed the merger of all these 7 subsidiaries into SBI Group, and now only one entity maintains, that is State Bank of India. So that is why this last classification of having State Bank of India and other nationalized bank doesn't hold ground now in 2018. The State Bank of India is now acting as any other bank, public sector bank, nationalized bank like Punjab National Bank, like Vijaya Bank, like Canara Bank, which are there in our economy. So once again, let us recapitulate what we understood in this session. The commercial banks are primarily divided into 2 parts: scheduled banks and non-scheduled banks. Scheduled banks are those which are included in the second schedule of RBI Act. Non-scheduled banks are those which are not included in the second schedule of the RBI Act. The regional rural banks are those banks which are sponsored by commercial banks, but they are having capital contribution by the central government and state government both. The scheduled banks are divided into Indian banks and foreign banks. How do we identify? The Indian bank is registered under the Indian Companies Act, and a foreign bank is registered as registered under the Companies Act of that foreign country. For example, in case of Indian Bank Act, we may have Punjab National Bank and ICICI Bank, while in case of foreign bank, we have HSBC, Hong Kong Shanghai Banking Corporation, or Bank of America, which are the foreign bank having their branches in India. The Indian banks are further divided into 2 parts: public sector banks and private sector banks. Public sector banks are those in which the government holding is substantial, sometimes 51% or more than that, whereas the private sector banks are those in which private individuals or corporations are having majority of the stake. For public sector bank, we have Canara Bank, Punjab National Bank. For private sector banks, we have ICICI Bank and HDFC Bank. The public sector banks were earlier, before 2017, were in 2 categories: State Bank of India and other nationalized bank, because State Bank of India was operating with 7 subsidiaries which were merged into one entity in April 2017, and that is why we are now having SBI. And other nationalized banks are those banks in which any government is having more than 51% of holding. So thank you.